gold is going up in all currencies because all currencies have an elevated inflation risk. But the risk in America, I think, is even greater given the potential loss of the reserve status. No other currency even has that status. So there's nothing to lose. Only America has something to lose. And what it has to lose is basically the pillar that's held up our entire phony economy. Without that reserve status, the whole, consumer-based economy that was built on top of that status comes collapsing down.
Gold's explosive rise above $4,000 is not random market noise. It's a clear signal of systemic weakness across global currencies, especially the US dollar. Every central fiat system today faces the same threat: inflation that can't be contained and debt that can't be repaid. The dollar, once the backbone of global trade, now stands on the edge of losing its reserve status, the very privilege that has propped up America's consumption-driven economy for decades. As foreign central banks accelerate their shift from U.S. Treasury securities to physical gold, the message is unmistakable. Confidence in paper money is eroding. Gold, as always, is the first to respond. It's the early warning siren of the next phase in the monetary reset. PeterSchiff, a leading economist and advocate for sound money, explains why gold's breakout mirrors the early cracks of the 2008 subprime crisis, only this time, the danger lies within the dollar itself. As he warns, waiting for a correction may mean missing the opportunity entirely. Real wealth will survive not in paper claims, but in tangible assets that can't be printed. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is the leader, right? Gold is forward-looking. Gold is far more sensitive to this than other commodities. So gold is going first, just like subprime cracked first. Like, why did the subprime market give before the rest of the real estate market? Because that was the weakest link. It was the most sensitive to what was happening. Well, gold is the most sensitive to this threat, to the threat of sovereign credit of the United States, to a threat to the US dollar system of the global monetary system. Gold is where you see it first, just like subprime was where you saw it first. The rest of it happened later, but too many people were dismissive because they said, well, we haven't seen anything yet. Yes, we haven't seen a bigger surge in base metals. I mean, they've gone up, but not as much as gold. Yes, we haven't seen a huge rise in bonds, but we've seen a rise. Long-term interest rates have gone up despite the fact that the Fed has been cutting short-term rates. So that's already happened, right? That was already something that the mainstream did not expect, that rates would rise as a result of the Fed rate cuts. I was predicting that, but pretty much nobody else was. So we've already seen the beginning of that. But yes, we haven't seen a bigger drop in bonds, and the dollar hasn't fallen over the last few months, but it is down about 10% on the year. This is the worst year in 50 years for the dollar based on how much it's already down. Now, it hasn't fallen more over the last several months, but that doesn't negate the fact that it already dropped quite a bit. But all these other things that Larry Kudlow was saying haven't happened, and so we don't have to worry, they're all going to happen. You just don't wait until after the fact to worry about it. You worry about it now. And the people who are worrying about it now, they're buying gold. That is what they're doing, right? And so gold prices are rising because inflation is going to rear its head in a much bigger way, because the US dollar is going to tank. Why do you think that foreign central banks want to get rid of their dollars? Why do they want to replace them with gold? Because they can see what's going to happen. They can see this debt bubble. They can see how it's going to be impossible for us to finance it. And so they want to distance themselves from the threat. So gold is moving first, and you can ignore this warning at your own financial peril, or you can heed it. And how do you heed it? Well, you buy gold and silver yourself, right? If you don't already own it, or you buy more, or you buy these mining stocks, that were up again today, but not nearly as much as they should have been up. I mean, some stocks made new highs, especially some of the silver stocks, but all the royalty companies ended up pretty much down on the day. And a lot of stocks didn't make new highs because stock investors are still skittish. They still think that there's going to be a correction. And, maybe there will be a small correction now that we've had so many news stories about gold hitting 4,000. I wouldn't be surprised if it pulled back $100 or $200. Now, it may not. What may surprise everybody is the lack of a correction, because so many people want a correction because they want to buy. That is the reality. There is a lot of money that wants to come in to the gold market, and they're waiting for a correction. That's why the corrections may not come, or if they do come, they'll be very short and very shallow and not really worth waiting for. But the gold stock investors are still skittish. And, so I think they probably expected gold to sell off before it hit 4,000. Now maybe they expect it's going to sell off now that it has broken 4,000. But we'll see. I mean, we could just go right to 4,100, 4,200 then maybe we'll pull back to 4,000. I don't know. But maybe we'll just go straight to 5,000, because there's something much bigger going on right now that the mainstream just doesn't understand. Just like they didn't understand the subprime. This is a very significant development. It's not too late to buy gold. I'm hoping that the people who have been listening to my podcasts, everybody owns some gold, everybody owns some silver. But if you don't, or you don't own enough, you should go to Schiff Gold tonight and buy some more. Yeah, it may pull back down now that we're at 4,000, but you know what? It won't pull back enough to make a difference in the scheme of things. Even if you buy it at 4,020 and it goes to 3,900 or 3,800, when it's 10,000 or 20,000, it's not going to matter. The risk is that you don't want to buy it at 4,000. You wait for 3,800 and it never gets there. And then next thing you know, we're at 5,000 and you still haven't bought it. So you got to buy it, and then, get out of these U.S. stocks, get out of U.S. bonds for sure. I mean, there's absolutely no reason to own U.S. bonds. I mean, that's where the carnage is going to be the greatest. But you got to get out of U.S. bonds. You got to get out of U.S. stocks, but you can't get into cash, right? You can't just sell your stocks and bonds, because then you got dollars that could go down even more. So you got to get into real assets outside the United States. You got to own dividend-paying foreign stocks. You got to own commodities. You got to own gold. You got to protect yourself from what's about to happen. I mean, most people are going to be defenseless because they don't even understand the threat. They're dismissive of it because they don't understand the nature of the problem. They think we have a great economy. We don't. We have a bubble. We have an illusion created by inflation. Trump is hoping to perpetuate that illusion by creating even more inflation, but it's not going to work, right? We have too much of inflation already to use inflation to mask the problems created by inflation. So we end up overdosing on it. And that's what gold is telling you. That's why it's rising the way it is. And that's why it's not going to stop.
Gold's 54% surge this year marks one of the strongest performances since the 1970s, a decade defined by monetary upheaval and the end of the gold standard. That period reshaped the global economy, igniting inflation and devaluing the US dollar after it was severed from gold in 1971. For decades, dollars had represented a claim on real money, a fixed weight of gold held in US vaults. But when convertibility ended, paper promises replaced tangible value. The result was inevitable. Currencies everywhere lost purchasing power as nations adopted debt-based systems backed by confidence rather than substance. Today's explosive rise in gold mirrors that same loss of trust. It signals that investors and central banks once again see through the illusion of fiat stability. The dollar's credibility, built on decades of faith rather than gold, is eroding, and gold is simply reclaiming its historic role as real money in a world flooded with IOUs. Let's get back to the interview.
In fact, year to date, the price of gold is up 54%. I mean, that is a huge move. First of all, the year's not even over yet. We still have most of the fourth quarter left. But the last time gold was up this much in a calendar year was the 1970s. Now, that was a very significant time period. And by the way, silver rose today by an even greater percentage. It actually traded above $49.50 at the high. As of this morning, or right now, it's back below $49. I think it's trading around $48.80. But the intraday high, it got above $49.50. So very, very close to $50 which is that key level for silver. But if you have to go back to the 1970s to find a year where gold was this good, and of course, it's not like gold had a bad year last year. Gold had a great year last year. It's just having an even better year this year. And of course, a 54% move from where gold was, dollar-wise, is a much bigger move. Think about the value of that move, because you're talking about a metal that's already, mid 2000s and moving up to 4,000. That's a big dollar value of the rise in what all the gold is worth. But if you've got to go back to the 1970s to find something like this, that probably means that what is happening now is likely as significant as what happened then. Now, what happened in the 1970s? You got to understand this, because it was 1971 that Nixon took us off the gold standard. It was supposed to be a temporary move, but it's now been better than 50 years, and we didn't go back on it. But that was a very significant development, because up until 1971, if central banks in Europe or anywhere held U.S. dollars in reserve, which they did, they knew that whenever they wanted to, they could take those U.S. dollars back to the U.S. government and exchange them for gold. It was a fixed rate. If you had $35, you had an ounce of gold. The Federal Reserve note was basically a receipt that paid the holder of that receipt an ounce of gold. You had $35, you could turn them in, and you could get an ounce of gold. Now, in the meantime, you could take those $35 and buy U.S. Treasuries and earn interest, which is something you couldn't do on your gold. But by allowing the Federal Reserve or the U.S. government to hold your gold, which is basically what the world was doing, right? We were the custodian of the gold, right? So Germany or Italy or France or the UK, they hired the U.S. government to hold custody of their gold. And we issued them a warehouse receipt in the form of U.S. currency that represented, a pay to the bearer on demand. Now, of course, at one time, everybody, right? You didn't have to be foreign to convert your paper into gold, right? The initial Federal Reserve notes before 1933 were redeemable in gold by everybody. So an American citizen that had $20, because back then the official price of gold was $20. So if you had a Federal Reserve note for $20, you could take it to the Federal Reserve and they'd give you a $20 gold piece, right? It was an even exchange. So that piece of paper represented an IOU for gold. In fact, that's what gave the paper the value. It was the gold that backed it up. Now, 1933, after Roosevelt, told everybody that to turn in their gold and made it illegal for Americans to own gold, Americans couldn't convert their notes into gold, but foreigners could. Right? It was only American citizens that couldn't get the gold. But if you were a foreign holder, you could still get gold. Now, Roosevelt devalued, so now you needed $35 to get an ounce of gold, not $20. But if you were outside the United States, if you were a foreign central bank and you held U.S. dollars, you were still able to redeem them. In fact, the pieces of paper weren't dollars. The gold was the dollar. The dollar was defined as a weight of gold. The Federal Reserve note, which was the piece of paper, is an IOU for dollars. The dollars were gold. Now, they were also silver. And in fact, while it was illegal for Americans to own gold, it wasn't illegal to own silver. And so they had silver certificates. The Federal Reserve issued currency backed by silver, and you were able to get silver up until, we took the silver away in 1963, 1964. And then we took all the silver out of our coins. But you were able to get silver because, you could take a dollar bill and get 4 quarters. And those 4 quarters were silver, right? So you were able to exchange your paper dollars for silver just by going to a bank and getting change, right? And you can get real money. You can get real dollars. You could get silver dollars, right? The Federal Reserve note was an IOU. In fact, if you read what it says on the Federal Reserve note, it doesn't say it's $1 or $5 or $10. It says pay to the bearer on demand, $10. The $10 is a weight of gold or silver. And so it's an IOU. So, but up until 1971, these foreign central banks who were holding US dollars were really holding gold. They were just storing it in the US, in Fort Knox. They were storing their gold. And we gave them this IOU. But what they were able to do with that IOU was purchase US Treasuries. So now they can earn interest on their gold because their gold was, they still owned the gold. They could get it whenever they wanted. But in the meantime, they were able to earn interest. Now, when we went off the gold standard, that was a major disruption of the world monetary order. And it led to a major devaluation of the US dollar, not only relative to other currencies like the Deutschmark or the Swiss franc or the Japanese yen or the pound sterling, but against gold. Because prior to 1971, if you held dollars, you held a currency backed by gold. After 1971, if you held dollars, you had a currency backed by nothing. Now, clearly, a currency backed by nothing is not as valuable as a currency backed by something, especially when that something is gold. So the world marked down the dollar because we changed the rules. We told everybody that you're not going to get your gold. We basically defaulted. When they talk about how the U.S. government has never defaulted. When they talk about the debt ceiling, we've never defaulted on our treasuries. We defaulted on Federal Reserve notes. The reason that a Federal Reserve note is called a note is because it is a promise to pay, right? What does the Federal Reserve promise to pay? If you own one of their notes, what are they promising to pay you? Well, initially, they promised to pay you gold, right? They promised to pay you real money, lawful dollars. That's what the promise was. But now the Federal Reserve notes are notes for nothing. It's an IOU nothing. It just says this note. It doesn't say what it's redeemable in. So we defaulted on those notes. The world held our notes because we promised to pay gold. And then we told the world, we're paying nothing. I mean, we didn't even say, we'll give you, 50 cents on the dollar, 25 cents on the dollar. We told the world, we're giving you nothing, right? We're not giving you any gold for these notes. It was 100% default.
The return of gold's dominance is not a coincidence, it's a verdict. For over half a century, the global economy has been built on promises detached from anything real, and now those promises are unraveling. Each new record in gold's price is a reflection of declining confidence in fiat currencies and the mounting realization that paper money always returns to its intrinsic value, zero. The financial order born in 1971 is reaching its mathematical limit. Debts too large to repay, inflation too persistent to ignore, and policymakers too trapped to act. Gold is not rising, currencies are falling. As this cycle accelerates, the divide between those holding tangible assets and those trusting in paper wealth will define the next era of prosperity and loss. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.